if you do run into more acute energy shortages, we don't do sufficient energy capex, and say, for example, we have a major multi-year sustained bull market in energy prices, or AI does not live up to the productivity gains that the bulls expect, for example, and doesn't offset some of the inflation enough, then you can get more acute issues where you get things like yield curve control. You get major currency devaluation relative to commodities or relative to consumer prices, and you basically get a restructuring of the debt. I mean, there's two major ways to default on debt. One is you can default on it just outright, and the other one is you basically print the difference, where you technically give all the units back, but all those units buy a lot less than they could before.
Opinions among experts regarding the future trajectory of the United States economy are sharply divided, particularly concerning the transition away from the current unsustainable fiscal trajectory. Since mid-September, the U.S. national debt has swelled by $1.2 trillion and nearly $7 trillion since February 2020, more than doubling over the past 12 years. Just 4 decades ago, the national debt hovered around $97 billion, taking over 200 years to accumulate the first $1 trillion in debt, and less than 50 years to amass the subsequent $33 trillion. While there is unanimous acknowledgement of the pressing debt issue, experts differ widely on potential solutions to this rapidly escalating problem. Federal Reserve Chair Jerome Powell, for instance, acknowledges the U.S.'s unsustainable fiscal path but believes that pragmatic dialogue among policymakers can lead to a resolution. However, for certain macro analysts and prominent investors, the outlook is bleak, with some asserting that the U.S. is already ensnared in a debt spiral, hurtling toward a protracted decline. In a recent interview with Skybridge Capital's Anthony Scaramucci, Lynn Alden, a renowned macro strategist, outlines 2 plausible outcomes for addressing the U.S. debt issue. The first scenario entails technological advancements creating sufficient deflationary pressure and enhanced productivity to manage the debt burden effectively. This outlook, recently echoed by Real Vision CEO Raoul Pal, envisions the U.S. navigating its debt challenges until breakthroughs in artificial intelligence address underlying productivity and demographic concerns. Alden's second scenario involves QE to infinity, where the Federal Reserve continues massive quantitative easing to service its debt. However, this approach risks further currency devaluation and rapid loss of value. In her discussion with Anthony, Alden provides deeper insights into the U.S. debt landscape and offers strategies for investors to navigate through these diverse scenarios.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The central bank and the federal government of the United States, irresponsible with the money. Is it now time to take the keys away from those people and put it into this decentralized technology?
I think the incentives are all there to do so, yes. I mean, I think people are going to be inclined towards whatever's the stronger money, especially if it's of a similar or faster speed than the weaker money. So, for example, over the past century, the biggest comparison was, say, gold and the dollar, whereas gold obviously held its value a lot better than the dollar, but the dollar had various advantages of speed and convenience. And so, even though the dollar was weaker, it was still stable enough that, especially when you combine, legal monopolies and legal tender laws, things like that, that the dollar was able to win out. One thing that's interesting about Bitcoin is that it's over the long term, it grows even less than gold in terms of new supply, so it's even scarcer than gold, and it can move around as fast or faster than fiat currencies can. And so that's a really compelling long-term story to get people to gravitate towards it and change some of the structure. Although, in my view, that's a multi-decade story. That's not like a 1 decade or a 2 decade story. It takes very long time to change these gigantic structures. And one thing that's notable about the Bretton Woods era is that a lot of focus is on that 1971 decision to leave it, but what the evidence shows is that it was breaking basically throughout the 60s. The Bretton Woods system, it was decided upon in 1944, it was implemented in 1946, but then it wasn't really even fully implemented until the late 1950s. That's when they undid some of the kind of the post-war era controls that were in place, and that's when they actually started that overall process. And from that point, the amount of gold reserves went straight down. And that's partially because we were running significant deficits. And it's also partially because banks, fractional reserve banks, were lending more dollars into existence, and they were not constrained by the amount of gold in the system. So you had an environment where, from 1950 to 1970, the broad money supply tripled as gold reserves diminished. And so the system was inherently unstable to begin with. It was always a rational decision to redeem some of those ever inflating dollars for gold until they were going to run out of gold. And so we kind of have this story where we centralize everything, and then over a matter of decades, that centralized entity fails. partially because it was just unstably designed to begin with. It was kind of, it was like great while it lasted, but it was designed not to last is the
Right.
challenge.
And,
And
and you make an interesting point because it decentralized things are more anti-fragile than centralized things. I think we both agree with that, right?
Yeah, and so for example, if you look at the history of the dollar, it was defined in 1792. And from there all the way up until the early 1900s, its purchasing power remained unchanged. It could buy the same amount of gold, it could buy the same amount of general goods and services based on most estimates. During wars, there'd be some period of inflation, but then it would kind of revert back after the war. And it wasn't until this more modern era where we began centralizing everything and growing the money supply on average at a faster rate, that we started to get this devaluation. And to your point about who it affects or who it helps most, basically it's kind of the economy is kind of like a game of blackjack, where with blackjack you want to get close to 21, but you don't want to go over. And the way that who best is rewarded in this economy is people that have debt, but not so much that they blow up in a recession. So if you have long-term low interest rate debt and you're using it to buy scarcer assets, real estate, business, cash flow, business equity, things like that. The closer you are to the source of money creation, you're shorting the fiat currency that everybody else is earning their wages in and saving their near-term money in, and you're buying scarcer assets, and you're doing very good, especially because you have global arbitrage. You can short one currency and buy assets somewhere else, for example. Whereas if you're on the other side of the spectrum and you don't have a lot of access to credit and you're just kind of earning wages, you're saving a little bit, you're getting constantly devalued. You're getting paid in melting ice cubes.
The issue of currency debasement currently poses a greater threat to emerging economies, but Alden anticipates its eventual global spread. Numerous emerging countries, spanning from Nigeria to Egypt, Lebanon, Argentina, Sri Lanka, and Zimbabwe, are grappling with alarming levels of inflation and staggering currency devaluation rates. Alden warns that this could become a reality for many developed nations in just a few years if governments continue to engage in indiscriminate printing of money. By then, currencies currently on the brink of collapse would likely be entirely wiped out, while those currently considered strong would lose significant value. Alden emphasizes that currency devaluation affects everyone, whether invested in traditional assets like stocks and bonds, running a small business, or relying on wages to support a family. The constant struggle is to keep pace with the devaluation rate, a feat many never achieve. This is why Alden and Anthony strongly advocate for investing in Bitcoin, a decentralized, trustless, and permissionless network, as opposed to the highly centralized and permission-based traditional financial system. In their view, Bitcoin offers a viable solution to safeguard against the perils of currency devaluation.
There's really no other way that other than to continue monetizing it, and that's the problem. So, for example, the Fed is interesting in the sense that when things get really extreme, they lose control. So, for example, the 1940s during the war era, they were just overtaken by the Treasury. They were forced to monetize the deficits and to keep them at low interest rates. And in the past couple of years, when we had these extreme events in various ways, they just jumped in and monetized it right away. And so they can try to be independent when things are going reasonably well, but as soon as you have a problem in the sovereign bond market or one of those adjacent markets, they always jump in. And so one thing that's interesting is that during COVID, Powell asked for more fiscal support. He said, "Look, our tools are kind of exhausted. We need more fiscal." But you don't really see the opposite happening now. You don't see him coming out and saying, "Look, we're trying to tighten, but these very large fiscal deficits are outside of our control. And if you want to more sustainably get inflation under control, you'd have to reduce those deficits. That's a fiscal decision." And you don't really see him doing that. And so I think one thing the Fed could do is say, "Look, I mean, our tools are mostly designed to affect the rate of bank lending. So we have tools that can kind of incentivize or promote the rate of bank lending, which is generally pro growth or pro inflation. We can slow down the rate of bank lending, which helps reduce inflation or help kind of slow things down. But if you're running very, very large deficits, that's going around our tools. And that's largely outside of our purview. And that's mostly a fiscal problem. So a lot of my emphasis is pointing out that in some ways, regardless of what the Fed does, it's largely a long-term fiscal spiral that we're going through. And even if you look at the Congressional Budget Office's long-term projections, it's just larger and larger deficits as far as the eye can see. And then you get that negative feedback loop where if the Fed actually tries to raise rates to slow down inflation, they exacerbate the deficit because there's so much debt relative to the size of the economy, and therefore the interest expense
Right.
goes up,
In the spiral.
and then they issue more debt to pay the interest. And so it's largely the source of the concern now, I would say, is emanating from the fiscal side.
Could we fix it? Is there a long-term plan that we could fix the situation?
Yeah, I think the challenge there is that the fixes would be so unpopular that those trying to fix it would be voted out, and then they go back to
Right.
not fixing it. So, for example, the demographics are such that things like Social Security and Medicare are not long-term sustainable as designed. They were designed in a different era. They weren't designed with the idea that population growth would eventually slow down and that the society would become very aged. So, if you look at, for example, how many workers pay into Social Security for every retiree, that number keeps shrinking over time, where it becomes a very big burden for the small number of workers paying in. And retirement age, was originally around the average human life expectancy. So some people didn't even make it to there. Some people went over, but in general, there weren't people kind of living on those benefits for many decades. Whereas in recent decades, our life expectancy has gone up quite a bit, but our retirement age has gone up at a slower pace. And so there's that ratio of longer periods of receiving support. And so you have this thing where it's just economically unsustainable. Also, I mean, the way that we structure our healthcare system and kind of the health problems we have, related to diet and things like that, have kind of blown out the deficit on the Medicare side as well. Arguably as big or bigger as Social Security. And so without kind of fixing the overall long-term balance of those, it's very hard to get the deficit under control.
According to Lyn Alden, the economic challenges we face today began to manifest in the 1980s when the national debt surpassed the ominous $1 trillion mark. Alden suggests that there could have been more significant consequences of this rapidly growing debt if not for certain factors that buoyed the U.S. economy. These factors include rapid globalization, a period of remarkable productivity with a substantial influx of people into the global labor force, lower interest rates, and the peak demographics in the United States with the baby boomer generation entering their prime spending years during the 1980s and 90s. As a result of these factors, policymakers were able to defer addressing the debt issue, effectively kicking the can down the road without serious consequences until now. However, Alden warns that the problems are resurfacing, now on a much larger scale due to the significantly higher debt-to-GDP ratio. Unlike the 1980s and 90s, the supportive factors for the economy are either deteriorating rapidly or occurring at a much slower pace. Consequently, Alden asserts that the U.S. economy is currently in a precarious state, teetering on the brink of disaster. Alden recommends that investors safeguard themselves against the impending crisis by investing in Bitcoin, one of the few assets that has consistently outperformed currency debasement, and is poised to continue doing so. What are your thoughts on Lyn Alden's assessment of the current state of the United States economy and the challenges ahead? Feel free to share your comments and observations in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.